This is a critical topic if you're planning for retirement or retirement is just around the corner. These common yet costly mistakes could significantly impact your financial stability and peace of mind. They could cripple your retirement. Stay with us to learn how to safeguard your hard-earned money and ensure a comfortable retirement. First up, let's discuss taxes. Many people overlook the impact taxes can have on their retirement savings. It's easy to assume that you'll be in a lower tax bracket once you stop working, but this isn't always the case. Required minimum distributions, RMDs, from your retirement accounts can push you into a higher tax bracket than expected. Without a strategic tax plan, you could end up paying far more than necessary. Consider using a comprehensive retirement planning tool that can forecast your tax liabilities year by year, helping you make informed decisions about withdrawals and minimizing your tax burden. It's also essential to consider the timing of your Social Security benefits and how they interact with your overall tax strategy. If you delay taking Social Security until full retirement age or even later, you could reduce your taxable income in the early years of retirement. Moreover, using Roth accounts effectively can provide tax-free withdrawals, which won't increase your taxable income. This strategy can help you stay within lower tax brackets. Additionally, be aware of the impact of state taxes on your retirement income, as some states have more favorable tax treatments for retirees. Planning for taxes is not just about federal taxes. State taxes can also significantly impact your retirement finances. It's important to review your tax strategy annually and adjust as needed, considering changes in tax laws and personal circumstances. Staying proactive and informed will help you minimize tax liabilities effectively. Additionally, consulting with a tax professional who understands the intricacies of retirement taxes can provide personalized advice and ensure you're optimizing your tax strategy throughout retirement. Another significant error is ignoring non-monthly expenses. These are big-ticket items that don't occur regularly but can severely impact your budget when they do. Think about replacing your roof, buying a new car, or even covering a wedding. These expenses need to be factored into your retirement plan. Ignoring them can lead to unpleasant surprises and financial stress. Make sure you have a clear plan for these one-time costs and consider their timing to avoid unnecessary tax implications. Don't forget to include maintenance and unexpected repairs in your retirement budget. For instance, household maintenance costs such as plumbing or electrical work can be substantial. It's wise to set aside a contingency fund to cover these unforeseen expenses. Additionally, consider potential increases in property taxes or homeowners insurance, especially if you live in an area prone to natural disasters. Vehicle maintenance and replacement costs should also be included. It's not just about the initial purchase price. Ongoing costs like insurance, registration, and regular maintenance need to be factored in to ensure a comprehensive and realistic retirement budget. When planning for these expenses, consider creating a separate savings account specifically for non-monthly costs to avoid dipping into your regular budget. This approach can provide a clearer picture of your financial health. Additionally, periodically reassessing these expenses and updating your estimates will help you stay prepared for any unexpected financial challenges that may arise. Inflation is another silent threat to your retirement. Failing to account for inflation can erode your purchasing power over time. While it might not seem like a big deal in the short term, over a 20 or 30-year retirement, even a modest inflation rate can drastically reduce the value of your savings. It's crucial to use realistic inflation assumptions in your retirement planning software. For instance, a conservative estimate might be around 5%, considering recent trends. This will give you a more accurate picture of your financial needs and help you adjust your spending and savings accordingly. When planning for inflation, it's also crucial to consider the specific types of expenses that are likely to be affected. Healthcare costs, for instance, tend to rise faster than the general inflation rate. Additionally, everyday essentials like groceries, utilities, and transportation can be subject to higher inflation rates. Diversifying your investment portfolio can help hedge against inflation. Consider including assets like Treasury, inflation-protected securities, tips, real estate, and commodities, which often perform well in inflationary environments. Staying informed about economic trends and adjusting your retirement plan as needed will help you manage the impact of inflation over the long term. To further protect against inflation, consider including investments that traditionally outpace inflation, such as stocks and real estate. Additionally, maintaining a diversified portfolio helps mitigate risk. Regularly reviewing and adjusting your investment strategy in response to market conditions and inflation trends will help ensure your retirement savings maintain their purchasing power over time. Next, let's talk about medical expenses. Underestimating healthcare costs is a common and costly mistake. Many retirees assume their medical costs will remain stable, but the reality is that healthcare expenses often increase with age. Long-term care, medications, and routine medical visits can add up quickly. It's essential to research and choose a health plan that suits your needs. Options like high-deductible plans, health savings accounts, HSAs, and even health-sharing plans can provide more affordable alternatives. Always ensure you have a comprehensive understanding of your potential medical expenses and plan accordingly. One critical aspect often overlooked is long-term care insurance. As we age, the likelihood of needing assistance with daily activities increases, and long-term care can be prohibitively expensive without proper coverage. Research and consider policies that fit your needs and budget. Additionally, understanding Medicare and its limitations is crucial. While Medicare provides substantial coverage, it doesn't cover everything. Supplemental insurance, or Medigap, can help fill in the gaps, especially for services like dental, vision, and hearing, which are often not covered by traditional Medicare. Proactively managing your health and wellness can also help reduce future medical expenses. Reviewing your healthcare coverage annually and adjusting as necessary can help you stay on top of changes in medical expenses. Additionally, staying informed about new healthcare options and policies can provide opportunities for better coverage and cost savings. Regular health checkups and preventive care are also essential for managing long-term healthcare costs effectively. Finally, a major error is ignoring spending changes as you get older in retirement. Your spending patterns will likely shift throughout your retirement. The early years, often called the go-go years, might be more active and costly as you travel and pursue hobbies. However, as you age, your spending is likely to decrease. It's essential to adjust your retirement plan to reflect these changes. For instance, you might budget higher expenses for the first 10, 15 years of retirement and then reduce your projected spending for the later years. This realistic approach can help you better manage your savings and ensure they last throughout your retirement. Moreover, anticipate that healthcare spending will likely increase as you age, particularly for long-term care services. Be sure to factor these potential increases into your later retirement years. It's also beneficial to revisit your budget regularly and adjust as needed to reflect changes in your lifestyle or health status. Consulting with a financial advisor who specializes in retirement planning can provide valuable insights and help you create a dynamic spending plan. Consider the impact of major life events, such as the loss of a spouse or a significant health diagnosis, and how they might alter your financial needs and spending patterns. It's beneficial to regularly revisit and update your retirement plan to reflect any significant changes in your financial situation or lifestyle. This ongoing adjustment ensures that your plan remains aligned with your evolving needs and goals. Working with a financial advisor can provide additional insights and strategies for managing these changes effectively. Retirement planning is a multifaceted process that requires careful consideration and regular adjustments. Avoiding these expensive errors, underestimating taxes, overlooking non-monthly expenses, ignoring inflation, underestimating medical costs, and failing to adjust for spending changes can make a significant difference in your financial stability and overall peace of mind. By taking proactive steps and utilizing comprehensive planning tools, you can ensure that your retirement years are comfortable and secure. Remember, the goal is to enjoy your retirement without the constant worry of financial insecurity. If you found this video helpful, please like and subscribe to The Smart Retiree for more valuable tips and insights. We appreciate your support and look forward to helping you navigate your retirement journey. Thank you for watching and see you next time.